Three, two, one. Welcome to Anchor Point Stock Market Trading Adventures. I am your host, Captain Drew, and you are on my ship. I am showing you how I got here, how I learned to sail in the stock market, and you're essentially following along. This is not financial advice. Please do not do what I'm doing expecting to make money. So today, what I'm going to go through is some of the advice that I wish I was given when I first started trading. And I'm going to give you a little bit about my history. Then I'm going to go into how to get started if you know nothing about the stock market. And then I'm going to go through a couple charts and just show you how I assess each chart and what I look for. It's pretty darn simple once you get to understand the little characteristics that we look for in charts, as well as in the fundamentals, in the earnings reports and all that. So I'm going to try to make this as easy as possible for you. If I miss anything, or if you have any questions, or if I left something out, please let me know. But I'm going to start off with just giving you a little bit of a history, very brief. 8 years it took me about. I started in 2016. Trading actively and learning. I knew literally nothing about the market, so I did a lot of floating from one area to the next. I learned a lot. I started off in penny trades, and then I went off into shorting the market in penny trades, and then moved on into futures markets, got interested in that, learned all about that for a little while, then went into the derivatives. Futures are part of the derivative markets, but puts and calls specifically is what I'm talking about. The options world, got a little bit into that. I thought that was the way to success. And anyway, I feel like I've been down every avenue, and I landed on something that made the most sense to me, something that has a lineage in success. We're talking about career stock market traders who have passed down knowledge from one to the next and to the next, and then refined the art of trading in the stock market. And once you understand how to do this properly, you'll realize that it's timeless. The methods used 100 years ago with Jesse Livermore are still used today with Mark Ritchie II, who was mentored by the same person who essentially mentored me, of course, through books, not directly. I don't think he understands the impact he's had on my life, but for some reason, if Mark Minervini is listening, thank you. I owe you a lot. I appreciate you making everything more putting it in a way that I was able to understand. So Mark Minervini is who I recommend. Follow Mark Minervini. He was taught by Bill O'Neill. Let me just see if I can find Mark Minervini, a picture of him here. Mark. And you can find him. This is Mark Minervini. He has 2 books that I recommend. I recommend that you start with the blue one, okay, and then move to the black one afterwards. And then there's one more book I want you to read. This is all how to get started. If you know nothing about the market, do not read any of those Market for Dummies, or do not talk to your bank about how to do this. What they're going to tell you to do is they're going to give you an approach of someone who doesn't want to be active. If you genuinely want to be active in trading and you want to do this, for like I do, for a career, and you enjoy watching the world and the companies that come out of the world, and the little changes in markets. If you genuinely enjoy that kind of stuff, then and you want to do this actively, I don't recommend that you go to a bank. They're just going to give you basic financial advice about how to balance your portfolio and all that stuff, which really, you're going to be looking at a couple percent by the end of the year. Good for you. We're looking for some bigger gains. If that is what you want to do and you like the passive way of trading, then yeah, go for it. Go talk to your bank and see what kind of mutual fund you can put some of your money in. If you don't like doing this actively, I have a passion for the market. I love just passing through each chart one by one and then looking for the patterns that I'm looking for. And we're going to talk about a little bit of that. This is a brief overview of what to do if you've never looked into the stock market. So I recommend that you read these two books, okay, again and again, honestly, because there's a lot of information. You're going to be drinking from a fire hose. And then I recommend you read this one, Bill O'Neill, How to Make Money in Stocks. This will give you everything you need to understand for technical analysis. And just so you know, Mark Minervini was taught by Bill O'Neill. Not everything was that Mark knows comes from Bill O'Neill. He's learned from Darvis and Love and a whole bunch of other names, but it was Bill O'Neill who convinced him that he doesn't need to look beyond stocks and companies and the equities market, and convinced him that this method of trading works. And what is this method of trading? I'm going to tell you. This goes back through history. Do yourself a favor. Don't listen to any internet gurus on how to trade. Follow the career traders like Mark Minervini and Bill O'Neill, and you'll understand why this system works when you do it like some of these career-long traders. IBD Daily. This company here used to be a not a website. It used to be a magazine that they'd pump out in the 60s. This was Bill O'Neill's work. This is his company, Investors Business Daily. And something that he has in Investors Business Daily that I can't find anywhere else is a direct comparison between market action, the general market, compared to, the S&P 500. If you don't know what that is, I'll tell you in just a moment. And then the companies that we're looking at. And that's what he calls the relative strength rating. That's not the same as RSI. Those are two different things. Relative strength rating compares this particular stock with the general market and gives you a rating out of 99. So 98 is pretty darn high. That's one of the reasons I do have a subscription to Investors Business Daily just for this program here. And this is where I essentially find all of my stocks, because I can look at the entire library, the entire IBD data table, which is something like, 9,000 usually. If I turn this off, you'll see, it's 10,000 now. It's come up. So it's 10,000 charts. And then I turn on my screener, and I have 3 screeners here. One is relative strength over 99 or 97. One is relative strength 96. You can pause and look at all the attributes I put in here, including volume, price. Everything's over $10. And then the other is IPOs, new companies that have listed publicly in the last 3 years. And that's essentially, those are the 3 categories. And I export these suckers out. I convert them into, I put them into here essentially, and I'll show you what I have here. So this is the high RS, the relative strength over 97. I'll just move this over. This is what I did this weekend. So we got all these stocks here. You can see it's a lot. So I average about 600 charts, anywhere from 400 to 600 charts, depending on what's going on. Here's the IPOs. This is the relative strength. And then there's one more. It's the high composite. High composite is just something that has high relative strength and high doing well on their earnings at the same time. So I look at all of those. I go through, and what I essentially do is I rapid fire through these suckers. I push spacebar, and I just look for the patterns that I need to find. And the pattern, once you understand the pattern, and I'm just going to pull out my Microsoft Paint here because I'm not too fancy. I'll show you what the pattern looks like essentially. Now, this is, if you look in a standard trading manual, you'll see this type of pattern. So the stock will break out, and then it'll kind of create. Oh, this is terrible. Can I do something a little bit thicker here? Change the brush to, yeah, sure. Let's do. Can I make it thicker? Okay. We're not going to worry about how to thicken this up right now because I don't know how, essentially. So okay, so we're gonna just try to make this pattern work. Oh, is this it? Okay, so what we're gonna do I'm going to show you what the chart looks like here. So this is the pattern we're looking for. Essentially, a pattern will, excuse me, the chart will come up, and then it'll kind of create this back and forth pattern like this. And this is called a continuation pattern because it's going to continue up, or Mark Minervini calls it a volatility contraction pattern. And he calls each of these tightenings from here to here, from here to here, and from here to here. And essentially, you're wanting for this to tighten up, and you really want it to get tight on the end. And if you want to understand why you need that, I'm not going to go into that today. I'm giving you a basic outline of how I do this. Okay, so once you find those companies that have good volatility contraction patterns, let's see if I picked some out for this week. A lot of my picks are about here. This is something similar, but it's a little bit different. This is kind of a volatility contraction pattern. I had a really good one. This is a nice one here, except this has a couple problems. For anyone who kind of knows what I'm talking about, just so you understand why I picked this one, this blew out of the marker. Look at that, 122.45% up from that breakout. That tells me, and it did it rather quickly, and it held above that line. This is a power play, and I'm not going to get into all that. There's different play options and different ways you can do it. Just read the Minervini books, and then read William O'Neill. They're essentially the same. Minervini learned from Bill O'Neill. So you'll start to understand the pattern. But just so you know what I'm doing, that's what I'm looking for. I'm looking for a volatility contraction pattern. I don't like how deep that is. However, that's pretty much the example I have. I don't like how deep that is either. Some of these look better than others. Okay, so once you read those books, then you're going to eventually need to you have this. You don't need this subscription to start off with. You can just look at companies that have high or new highs. One of the things I need to point out, because I might be talking to some newbies here, a lot of people think that the time to buy a stock is when the stock is coming down and it gets cheaper. That it couldn't be further from the truth. The way the professionals do it is they're looking for the highs. They're waiting for this to go up high. You don't want to catch trapped buyers. Let me show you, like TSLA, Tesla. Everyone knows Tesla. I'll show you where the right time to buy Tesla was. You don't want to buy it at its peak. You want to buy it on a volatility contraction pattern coming out. This would be a nice little pivot. I still wouldn't buy it there. I would probably buy it over here. But you want to buy it on its way up, outside of the base, as it explodes up. We're trying to catch the short amount of stocks that explode out of the gate. And then, there's something called bases. This is all going to be in the books, guys. I'm not going to go through all of this. Go read the books for yourself. There's bases. There's going to be bases. Every base is going to create a small little contraction pattern, and it can explode back out. This is a terrible example because these bases are very short, only a few days. Tesla blew out of the water is pretty good. I'm curious what it did blow out with. Let's see. Just going to measure this really quick just for my own curiosity. Oh yeah. I mean, came right back down too. I mean, it's not the most perfect stock, but there. This is a nicer base coming out of the base here. Look at that tightness. So this would have been a nice spot to pick it up, and then you can see it on the volume too. And once you start reading volume, this is the number of traders that were trading. Okay. So if there's heavy volume on the upside, that's a good thing. If there's heavy volume with a massive dramatic drop down, that's a bad thing. We don't want that. So and you essentially start to learn all the little nuances and all the little tiny things in a stock, and it takes years of practice. So that's what I wanted to talk to you about, is how long you can expect to struggle for before you actually find some success in the market. I used to listen to this program called Chat with Traders, an Australian fella. I think he's handed it off to someone else now. I've recently listened to some episodes, and it's someone else now. But about 115 episodes, I think, somewhere around 120, 115, I listened to religiously. I used to go through these episodes. It was all I listened to. No shows, no TV, no movies, just this, and that's what you got to do. Really, you gotta just saturate yourself and obsess until you can make it. But some of the stories that came out of there were a lot of people who have been in the market and they've done this full time as traders. And so he does interviews with them. And a consistent theme came out of these interviews, which was people would start trading, not knowing what they're doing. They'd blow up their account and they would borrow money or whatever, struggle to come back. And it took them anywhere from 5 to 10 years to figure it out. And I can tell you, even for myself, I didn't feel in control until about year 8. Okay. It took 6 years for me to even find Mark Minervini and then Bill O'Neill and this group of people. And took another, about year and a half, 2 years to study Mark before I was able to kind of hone my skills. And everything I learned in those 6 years before Mark, I mean, they come in handy. However, I want to save you some time and just tell you, just jump right into Mark Minervini. You'll be glad you did. You'll save yourself years of aimlessly trying to figure out the market on your own. Okay, so take it from someone who has experience and who has done this religiously for so many years and has gone down so many dead ends and dead avenues. Where I landed was Mark. Where I landed was Bill O'Neill, Darvis, Love, Jesse Livermore. These guys go back lineage after lineage, and every generation seems to fine tune what the last one did. Okay, so you will find little nuances, but their skills and what they look for, the patterns that they look for, and the earnings reports, all exactly the same. You'll find Minervini and Bill O'Neill are like the same entity when you read their books. There are some differences, but the overall message is pretty much the same. You're not going to find too many differences between the two of them. So with all that said, once you figure out how you're trading, you have the technical analysis, which is the chart reading, okay, between the volume and the chart, and you don't need any fancy indicators. All you really need is your simple moving averages. And this up here, just so you know, this is just the S&P 500. This is nothing. This is just so I can compare. These are lines I put in for these days that are we're hitting new lows, just so I can see how the market that the stock that I'm looking at did in relative to the S&P 500. And I like to see it moving in the opposite direction and kind of having a mind of its own. That tells me a company is looking pretty good. And so I look for these lines here. See, I don't like how this dropped so dramatically, although it came up a lot, and my happy place is 50% of what it came up if it did have a massive move up. So, okay, let's move forward. I don't want to dilly daddle and take up too much time here. Once you have all this figured out, and you understand how to read technical analysis, which is the actual earnings reports. I'm going to go into that later on. Then you need to start trading. If you're in Canada, the only real brokerage account that you can get is Interactive Brokers. IBKR is their ticker symbol. They're actually doing pretty good right now. This is the only company that I would trade in Canada, only because it's international, it's professional, and the price is right for every trade. Just so you know, this is the company that I use for my personal trades. I do live in Canada, and I do need something that charges as low commissions as possible. So in case you didn't know, every time you buy a stock, whether it's 1 or 100, or sell a stock, whether it's 1 or 100, you're spending a little bit of money on commissions. I'll give you some price examples because I do know some. Scotiabank in Canada will charge you about $14.99 per trade. That means when you buy, you're spending $14. When you sell, you're spending $14. CIBC, about $6.99, significantly better. That means to get in and out of a market, that's about $12-13, or well, $14, $7 essentially. So that's, you have to buy those commissions when you purchase the stocks and when you sell them. Okay, if you sell twice because you're dividing up your stocks and you're only selling half the first time. You have every transaction that you make in the market, you're going to pay those commission prices. What makes Interactive Brokers special is the fact that they charge only $1. So I can be in and out of the market without worrying about commissions eating up my account, especially when you're starting off small. $2,000 or $1,000 or $10,000 or $25,000, whatever your flavor is when you're small. You certainly don't want high commission rates to eat up your account. Okay. I want to move on into the fundamentals. Okay, well, no, wait. Let's not get off track here. Interactive Broker, you're going to open up an account with them. You're not going to put any money into it, and you're going to use what's called a paper trading account. Paper trading account is essentially you trading fake money in the actual stock market. And just a side note, you want to use an amount of money that is realistic. Like, don't go in with millions of dollars on your paper trading account and then buy thousands of shares at once. That's just not realistic. You want to go in with just a small amount of money, whatever is realistic to what you're probably going to put in the market. If you're going to start off with $500, that's fine. That's fine. I know a lot of people think you need thousands upon thousands of dollars to get started. No, look, the majority of the work just goes into learning. Some of these guys, look up the U.S. stock market, U.S. investing championships, of which, by the way, some of the top contenders and top holders of records are from the Minervini program, just so you know, or students of Business Daily, Investors Business Daily, IBD, with Bill O'Neill. Bill O'Neill, by the way, I'm going off on so many tangents because this was not scripted. This is all off the cuff here, off the fly. I just want to show you Interactive. Nope, Investors Business Daily. IBD Live. Just type in IBD Live and you'll find it. They will assess the market every day at 4 p.m. So it's a good idea to start listening to some of these shows every day at 4 p.m. after the market closes. IBD Live is doing a show for about half an hour or so. And it's a good idea to start listening to these just so you can get some of the language in place so that you understand the, stock trading talk. Some of the language might be a little bit foreign. It also gives you some trading ideas, and they assess some stocks as well, so you can kind of get a handle on that. I don't recommend you listen to anyone but yourself. Learn to analyze the stocks yourself and learn to do the work yourself, because otherwise you're going to be going in blind and having someone else lead the way. By the time you've bought the stock, you're probably too late anyway if you're following someone else. Even these guys. I know it's William O'Neill's company. I still recommend that you learn to do this and actually apply the knowledge that you've learned. You don't have to follow these guys. You can just, by the time you do this the right way and you read some of those books again and again and you practice, you're going to be so confident at looking at these stocks, which at the end of this, I'm going to go through a couple stocks with you just so you understand exactly what I'm looking for. We'll assess some of these together. So where did we leave off? Interactive Broker. If you're in Canada, if you're in the US, just find the lowest commission stock and just go with that. Okay. And then don't even use their account just yet. You're going to want a couple years under your belt of making mistakes with orders and putting in orders, and because there's different types of buy orders. There's a stop limit order, there's limit orders, there's stop losses. You want to get familiar with all this lingo. By the way, just so if you do need a little bit of quick definition, for example, stop loss, if you need to know what a stop loss is, Investopedia is one of the places that I started off, and I still swear by them. I don't need them anymore, but for anyone who's looking for just a little bit of basic information, basic knowledge, Investopedia is your go-to. I do still use them once in a while if a term comes up that I don't know. It's rare, but I will always be a student of the market. So if something comes up, I certainly will not hesitate to look up the information. So investopedia.com, that's a good one. I also want to bring your attention to finviz.com. This is really great. I love this website. This website, if you go to the groups section here, you can see all the sectors and how they're doing in their 1 week performance, their 1 month performance, and then you can even get further into it. There's been a lot of financials. I noticed a lot of financial charts setting up. So and then you just get a whole bunch of charts, and you can really narrow down the type of chart that you want. In fact, if you're just starting off and you don't want to pay for Investors Business Daily, the screener, which is a little bit of a luxury, I'm not going to lie, it does certainly makes things easier. I have a full-time job and a family, so for me it's worth it. But if you have the time and you want to do this manually, there's a lot of free options. Finviz.com is a fantastic one. You just go to screener, and then you can type in you can put in some of the attributes that you're looking for. You certainly want your stocks to be above the 200-day moving average. You want your 50-day simple moving average to be above your 200, and you want your 20 to be above. You're going to learn all that from the book. I'm not going to go through that with you, but I might as well tell you one more thing. Your price, you want to set your price to less than your target price. Oh my goodness, where is it? Price to over $10. You don't want the penny stocks. They're not established, and as a result of that, they end up being extremely volatile. Okay, so they're up and down, and you don't want an up and down stock. You want a stock that is performing well. It's volatile on the upside, but the pullbacks are small. Okay, like this one. Look at the I want you to focus really on the volume as well here. Look at this. You have massive volume on the breakout. Okay. And then as it settles and comes down, you get lower volume. Massive volume on the breakout, and then lower, very low volume. Look at these two reds on the settling, on the, when it dwindles down a little bit. And then it holds that higher, but below this base, each of these is a base. Across here, down, put a little square around that. That's a base. You want your pullbacks to be light, and your breakouts to be high. Now, this is an outlier here. It did come back up. I like how it closed up here, but it's there is a contraction. I would have said at this point, if we were only here and I didn't see, and that's part of it. You can't see what's going on. You just have to follow the rules and make sure you're doing it right. I would not buy this stock if it was here, even though it did break out. You saw that, but I certainly couldn't, because look at this. It didn't contract. It's actually getting more volatile. It's getting bigger. We don't want that. Now it came up here and then set up again. I would probably measure that out. If it's under 10%, we're good. This is 6%, so it's in play. I do like seeing that bounce up in 3 days. Look at that. 1, 2, 3, 4, 5 days to come down, and then 1, 2, 3 to blow out of the gate. And then it pulled back again. And of course, on the breakout, it gapped up on this massive volume. Now, what is this massive volume here? What does that tell you? That's not Uncle Bob. Okay, that's not Aunt Susan sitting at her computer. This is an institutional trade here. This isn't retail traders. This isn't the small guys. These are the big guys here. We are looking for the signatures of large volume trades upon the breakouts to tell us that this has some institutional support. We are not market movers. We are retail traders, and we are looking to get on the backs of these big institutional trades so that we can have a trend moving upwards. While I'm on this topic, this is a good segue into how to assess a company. What I want to see now, okay, let's just go through this chart here so that I can explain it. This is quarterly. It's going to go quarter over quarter, and the most recent is down here. We have earnings per share in this box. We have sales in this box. And we have gross margin in this box. This is literally all you need to assess a company's fundamentals. You don't need to go into the nitty gritty. You don't need any more information than this. Okay. These down here, I also want to say these are earnings reports every quarter. Most companies, some are half year. Every quarter, they release their earnings reports. There's always an estimate from analysts, and then there's the reported. And the difference between the two, we call the surprise. We don't like to see negative surprises. Why? Because analysts are by nature very conservative in their estimates. They don't want to be outliers. They want to stay within the herd. They don't want to stand out. They're just doing their day-to-day jobs, just like anyone else. So as a result, they're very conservative in their estimates. So we want to see the reports blow these conservative estimates out of the water. If the actual earnings isn't above the estimate, which is already really conservative, that would worry me. That would mean that the company is starting to taper down in their earnings. And what moves a stock up? Here's a pop quiz. What moves a stock up? Why does the stock start moving upwards? Because the earnings are getting higher and the percentages are improving. So you can see look at just last year. This is 2023 or 2 years ago now. Look at this, 500, almost 600% change in earnings per share. This one's almost 300%. When I'm seeing these triple-digit earnings, these get me excited. I'm starting to lick my chops here. Now, I don't like that after that it started to dwindle down. I don't like, I like to see companies that are on the rise, not on the tapering down in terms of percentage surprise or the change quarter over this. Okay, I need to explain this here. These changes are comparing the same quarter from the previous year. So September of this year, or 24, this is being compared to September of 23. So it's this number versus this number. Okay, and that's what this is. So I'm going to go into the chart and show you what the forecast looks like, so I can kind of show you a little bit easier. So this quarter here, quarter 4 of 2024, is compared to quarter 4 of 2023. And quarter 3 of 24 is compared to quarter 3 of 23. We don't compare to the previous quarter. We compare to the last year, same quarter. That's just how we do it. That's how I was taught by Mark and Bill. They both say the same thing. Okay, I'm just going to trust the experts. I always start off with the annuals. I like to see that a company is growing. If a company is growing, the chart will explode out of the gate. If a company's not growing, then I'm not going to see that. Now, this is earnings per share. This is revenue. Revenue is the engine. So earnings per share is king. As long as their earnings are going up, but if the revenue isn't also looking good or at least going up, then I know the engine is getting sloppy, and probably the only reason their earnings per share is increasing is layoffs, or they're becoming more efficient as a company, or whatever. There's something to be played in the books. But I like to see revenue come up as well. So if you have these two things, you have earnings per share, revenue, and margin. See, this orange line here is net margin. If you have margins also rising, then you have a wonderful company. I don't like to see all this extra stuff here. A lot of people get trapped buying this thinking it's going to go up, and then whoops, it falls. Now, of course, how a lot of retail traders think. Well, if it's gone down, it's bound to come up. All companies come up, which is not true, by the way. So they'll hold, and they're waiting. They're typically waiting to sell out at break even. So we call this overhead supply. You'll hear about that in the book. Don't get it too confused. It's not a confusing concept, but it's going to take your mind a while to wrap itself around this. This is so when people get trapped, they want to sell. So that threatens where our price is here, because as it comes up, you might see big jolts downwards, and we call that overhead supply. There's a lot of supply overhead, a lot of supply. Okay. Um, so that's the basics. Now let's go through a couple charts and I'll show you how I do things here. I have my daily screen, which is, I showed you earlier. This is the 3 screeners that I use. I always start off with the high relative strength because I know that's where the power plays are. IPOs also very, very good runs on these. Sometimes, 25%, 30% before you sell. Nothing like a power play, though. Power plays are massive, sometimes 60, 70%. The average you're looking for is about 8 to 10%. And then you sell, take your money and run, right? Depending on how risk averse you are. There is one more thing. I'm just gonna throw this in here too. I know it's been going. How long we've been talking? 35 minutes. Holy moly! This is what we're gonna do. I'm gonna bring back Paint, and I'm gonna show you how to divide up your portfolio. So let's just say you have $10,000. This is what you want to do. You want to take all of your 10,000, divide it in half, each of those in half. So now you have 4 quarters. Okay, each of these quarters is considered a full size position. You never buy more than this in a single idea, in a single trade or stock. You also want to take one of these and divide this into 4. When you first start off, this is what you're going to trade with. One trade, one stock, 1/16 of your principal amount. If you buy another stock, it'll be another 16th. And you're just gonna get used to making money on very small amounts. And if you're still losing money, I would drop that down too, and start just trading 1/32s, 1/32. Okay, so that's an eighth of a full size position. Okay, 1/8. That's everything that you need to know to get started, essentially. Like I said, this is an off-the-cuff kind of tutorial. It's not too in depth, but I got it out there, and I got to be happy about that because I have kids and a full-time job, and sometimes getting this information out can be a challenge. If you have any questions, though, or comments, if there's something that I wasn't clear on or something that you want me to actually go into depth about, please throw it into the comment section. Okay. We got 43 subscribers. I'm pretty open. Chances are I'm going to see your comment. You know what I mean? Your 1 or 2 comments from my 1 or 2 fans. So please put it out there, and we'll get those questions answered. That's it for today. I'm going to be back next week. I'm going to trade through some of, or show you some of the stocks that I've selected. I didn't do that this week. I do have these names, but I still have to go through them. Actually, that's looking pretty tight up here. I might put a little position on that. I also like that the volume is tapering down. And yeah, we'll see how things are next week. Okay. What I might talk about next week is how to balance your time between a full-time job and doing the stock market, and some of the tricks of how to do that, using automated selling points and automatically having your stock brokerage account just make the trades. If it's not working out for you, how to make it automatically sell for you, and how to automatically buy as one of these stocks comes out of the base, and you want to be in that position, because where you buy is really important. You might be working with a client or whatever you do at a factory or construction, and you might not have time to look at your phone all the time. So I'll talk to you about how to set up a proper trade next week. So tune in next week for that. Okay, subscribe, like if you enjoyed this. And until next time, this is Anchor Point Stock Market Trading Adventures. I'll see you around. Trade hard.